Starting a business is exciting. It begins with an idea. You have a vision for something new. Maybe it's a product nobody has seen before, or a service that fills a gap in the market. This initial stage is all about turning that idea into reality. The first step, getting funding. In the beginning, money is tight. Many entrepreneurs use their savings. This is called bootstrapping. They invest their own money to get the business off the ground. Some ask family and friends for loans. Others seek out angel investors. Angel investors are individuals who provide capital for startups in exchange for ownership equity. At this stage, the business is very simple from a financial perspective. The accounting equation is straightforward. Assets equal equity. Assets are the things the business owns, like cash, equipment, or intellectual property. Equity represents the owner's stake in the company. It's the money they've put in directly or through investments. The goal in the startup phase is to validate your idea. You need to build something people want. This might involve creating a prototype. You'll test your product or service in the market. Early feedback is crucial. It helps you refine your offering. This phase is about proving your concept. You want to show that your business has the potential to succeed. Congratulations, your startup is gaining traction, customers love your product, you're ready for the next stage growth. This phase is full of excitement, it's also full of challenges. The business needs to scale up to meet demand. That requires money. At this point, many companies turn to debt financing. They take out loans from banks or other lenders. Debt financing provides the capital needed to expand. This could involve hiring more employees. It might mean investing in new equipment or marketing campaigns. Debt financing is different from equity financing. When you take on debt, you're not giving up ownership of your company. You're borrowing money that you'll need to repay with interest. This is where the accounting equation gets a bit more complex. Now it becomes assets equal liabilities plus equity. Liabilities represent the company's obligations. This includes the debt they've taken on. Managing cash flow becomes critical in this phase. You need to ensure you have enough money coming in to cover your expenses, including debt repayments. Growth isn't just about getting bigger, it's about getting better. You need to build a strong team. You'll also need to develop efficient processes. This will help you handle the increased workload. This phase can be make or break for many businesses. Careful planning and execution are essential. Your company is thriving. You have a solid product and a growing customer base. Now you're thinking even bigger, an initial public offering or IPO. Going public means listing your company's shares on a stock exchange. This allows anyone to buy and sell your stock. It's a major step that can provide a huge influx of capital, but it also requires careful preparation. Before an IPO, companies often seek additional funding. One option is Mandatory Convertible Bonds, or MCBs. These bonds are a hybrid of debt and equity. They act like loans with a twist. On a specific date, they automatically convert into company shares. This benefits both the company and the investors. For the company, MCBs provide immediate capital without immediate repayment obligations. This money can be used for growth initiatives. For investors, MCBs offer the potential for high returns. If the company performs well and its share price increases, investors profit when the bonds convert to stock. This stage is also about forming strategic partnerships. These partnerships can provide access to new markets or technologies. They can also enhance your company's credibility. A strong network of partners can be invaluable as you prepare for an IPO. The IPO is on the horizon. This is a complex process that requires expert guidance. You'll need to assemble a team of experienced professionals. This includes investment bankers, lawyers, and accountants. They'll help you navigate the regulatory requirements. They'll also ensure a smooth IPO process. One important aspect of preparing for an IPO is establishing an employee stock ownership plan, or ESOP. An ESOP allows your employees to own shares in the company. This aligns their interests with those of the shareholders. It's also a great way to attract and retain top talent. The IPO is a major milestone. It's not the finish line, it's the beginning of a new chapter. As a publicly traded company, you'll have access to a wider pool of capital. You'll also be subject to greater scrutiny from investors and regulators. Transparency and accountability are crucial. Continuous improvement and innovation are essential. Remember, the journey doesn't end with the IPO, it's just the beginning of an exciting new phase in your company's growth story.